All right, let's talk about one of the absolute biggest puzzles in finance. You spend your whole life saving up for retirement, but then what? How do you actually make sure that money lasts as long as you do? It can feel super complicated, but today we're going to break down the key to solving it.
And right out of the gate, we run into something that feels like a paradox. You always hear that the stock market, after inflation, gives you about a 7% return on average. So, logically, you'd think, great, I can just take out 7% a year, right? But nope, the so-called safe number is way lower. Why? What is going on there? That gap is the mystery we're cracking today.
So first, let's just make sure we're on the same page. We're talking about the Safe Withdrawal Rate, or SWR. Think of it as the magic number, the percentage you can pull from your investments each year, adjust for the rising cost of living, and have a really good shot at not running out of cash for a good 30 years.
Now, you've probably heard of the 4% rule. This idea was made famous by a financial planner named William Bengen, and it basically became the industry standard for decades. What's really interesting, though, is that Bengen himself has updated his own research and now says, you know what, 4.5% is actually a better starting point.
Okay, so back to our puzzle. If the market returns are so good, why is the withdrawal rate so low? Well, the hidden danger, the villain in our retirement story, isn't the average return you get over 30 years. It's the wild, unpredictable swings the market takes along the way. It's all about volatility.
And that volatility creates this very specific and dangerous threat for anyone in retirement. It's called sequence of returns risk. Basically, it's the risk of getting hit with a nasty bear market right when you start withdrawing your money. Bad returns early on can do permanent damage to your portfolio because you're selling low to fund your life, and it's incredibly hard to recover from that. So to figure all this out, researchers don't just guess. They run thousands of computer simulations. They'll basically generate a random but realistic 30-year market history, simulate taking money out every year, and see if the money lasts. And they don't just do it once. They repeat this process hundreds of times for every scenario to see what the probability of success or failure really is.
So, what do those simulations show? Well, let's see what happens if we get a little aggressive and try to pull out 6% a year. And whoa! Look at that! It's a sea of red. Each one of those red squares is a timeline where the retirement plan failed. The money ran out. At 6%, you can see that failure is pretty much the default outcome.
Okay, now let's try dialing that back to the 4.5% that Bengen suggested. And look at that. All of a sudden, this massive safe zone of green appears. These are all the scenarios where the retirement plan worked. So the whole game changes. The question isn't if you can succeed anymore, it's how you build a portfolio that lands you in that beautiful green zone.
So as you look at this chart, you're probably wondering what the heck these axes are. What actually determines whether you're in a red failure square or a green success one? Well, it all boils down to the interplay between two crucial factors, the return you're getting and the risk you have to take to get it. Let's define those real quick.
Okay, the bottom axis is real return. Now, it's easy to get excited by the headline number, the nominal return. Your account went up 10%. But if inflation was 4%, your actual purchasing power, your real return, only went up by 6%. When you're retired and living off your money, real return is the only thing that actually matters.
And that vertical axis, that's standard deviation. It sounds technical, but it's just a way to measure volatility, or risk. It tells you how much your returns are bouncing around. A low number is a nice, smooth ride. A high number, well, that's a stomach-churning roller coaster with massive ups and downs. Okay, so now we understand the map. We have our zones of success and failure, so here comes the million-dollar question. Where do actual, real-life investments fall on this thing? Let's overlay some common portfolios onto our chart and see what happens.
If we look at the extremes, you see the problem immediately. You can invest in super safe bonds. They have low volatility, which is great, but their returns are so low they don't even make it into the green zone. On the flip side, you could go all in on the S&P 500. Amazing returns, but the volatility is just way too high. It lands you deep in the red.
So if 100% safe is too conservative and 100% growth is too risky, what's the answer? Well, it's the mix. It's diversification. Look at those portfolios right in the middle, like a 60-40 stocks to bonds mix. They get enough of the stock market's growth, but the bonds help to tame that wild volatility. And where do they land? Smack dab in the middle of the green zone. That's the magic.
And if you're still not convinced, this visual makes it crystal clear. Each one of these lines is one possible 30-year retirement journey out of hundreds of simulations.
On the left, you've got a portfolio that's 100% stocks. On the right, a diversified one. The difference in the potential outcomes is, well, it's staggering.
I mean, just look at the chaos on the left. So many of those lines just plummet to zero. That's a failed retirement, a disaster. But now, look at the right. The diversified portfolio is so much more stable. The lines are packed together. Sure, a few don't do great, but the vast majority survive and many thrive. It's undeniable.
All right, so we've waded through the theory, we've seen the charts, and we've found the key. Now, let's just boil this all down into some practical takeaways you can actually use.
Here it is, the single most important lesson of this entire explainer. When you're in retirement, managing your risk is actually more important than chasing the highest possible return. Taming that volatility, that roller coaster ride, is what keeps your plan alive.
And the way you do that is through diversification. The science behind it is this concept of anti-correlated assets. It's a fancy term for a simple idea. Own things that don't all go up and down at the same time. Historically, when stocks zig, high-quality bonds often zag. That balance is what protects you from that terrifying sequence of returns risk.
So what do you do with all this? The big takeaway, the do, is to focus on the principle. Managing risk through smart diversification is critical. The do not is just as important. Don't just grab the number 4.5% and assume it's perfect for you. This is a framework for thinking, not a magic number.
And that leads to one final really important disclaimer. These models and simulations are fantastic tools, but they are not a crystal ball. They rely on historical data and statistical patterns, but the real world can be a lot messier. These models give us guiding principles, not perfect predictions.
And that leaves us with one final question for you to think about. It's really easy to build a retirement plan that looks great on paper, one that works based on average returns. But after everything we've seen today, the real question is your plan ready for reality? Is it built to survive the ride?